Good morning and welcome to the market opening bell on Thursday, June 12th. President Trump announced that the US-China agreement is finalized, pending final approval from him and President Xi Jinping. The deal includes China's pre-supply of magnets and rare earths and allows Chinese students to study at US universities. The US will impose a 55% tariff, while China will impose 10%, and Trump emphasized the strong relationship between the two nations. In Hong Kong, stock rose again after a slight pullback on Wednesday. The Hang Seng Index opened 28 points higher, later climbing 276 points to 24,439, a 2.5-month high, before closing up 204 points or 0.8% at 24,366. The X-share index gained 98 points or 1.1% to 8,865, and the Hang Seng Tech Index increased 59 points or 1.1% to 5,451. Total market turnover reached 235.1 billion Hong Kong dollars. Southbound funds net bought 1.376 billion Hong Kong dollars in Hong Kong stocks, with notable net buys in China Construction Bank at $706 million, Meituan at $370 million, Innovent Biologics at $250 million, and Sinopec at $160 million. Conversely, net sales included Xiaomi at 1.832 billion, Tencent at 1.256 billion, Alibaba at 781 million, Kuaishou at 326 million, and Bank of China at 310 million. Southbound funds have net bought Meituan for 18 consecutive days, totaling 18.882 billion Hong Kong dollars, and Innovent Biologics for 3 days, totaling 1.86 billion. Meanwhile, they net sold Tencent for 9 days, totaling 11.2 billion. Xiaomi for 7 days, totaling 8.361 billion, and Alibaba for 3 days, totaling 2.493 billion. From a technical perspective, the Hang Seng Index reached its 24,400 target, with the next target at 24,750, followed by the March high of 24,874. A break above this could push the index toward 25,400. Mainland China markets also advanced, with the Shanghai Composite Index rising 18 points or 0.5% to 3,402, and the Shenzhen Component Index gaining 84 points or 0.8% to 10,246. Combined turnover was 1.255 trillion yuan, down 159.9 billion yuan from the prior day. The renminbi central parity rate was set at 7.1815 against the US dollar, up 25 pips, marking a 2.5-month high. In the Hong Kong market, the auto sector saw gains after automakers announced shortening supplier payment terms to within 60 days, aligning with the Payment Protection Ordinance for SMEs to stabilize supply chains and support small businesses. NIL rose 4%, BYD gained 3.8%, and XPeng increased 3%. Industry sources noted that automakers often demand annual price reductions for parts and extend receivables from 45 days to 90 days or more. According to Wind Data, the average accounts payable period for 16 listed Chinese automakers is 182 days, nearly double that of international peers. In 2024, BYD's accounts payable reached 244 billion yuan, surpassing 250 billion yuan this year, while Geely stood at 182.4 billion yuan by year-end 2024. Suppliers often rely on commercial acceptance bills to manage cash flow, increasing financing costs. The new policy alleviates the pressure but strains automakers' cash flow, particularly for smaller firms, potentially raising bad debt risk for suppliers if automakers' finances worsen. The steel sector also performed well, following an article by the China Iron and Steel Association titled "Safeguarding the Overall Interests of the industrial chain and jointly resisting involution competition. The article highlighted that automakers' aggressive cost cutting has pressured steel makers to lower auto steel plate prices, with some demanding over 10% price cuts since last year, exceeding steel makers' capacity. Recently, certain domestic automakers priced auto steel plates like ordinary steel in tenders, sparking involution among steel makers, with contracts typically awarded to the lowest bidder. The article noted that auto steel plates, a flagship product for leading steel makers, are currently near zero profit. Yet automakers continue to demand price reductions. In 2024, key steel enterprises reported 6.02 trillion yuan in revenue, with an average profit margin of just 0.71%. US stocks opened higher but trended downward with volatility, with tech stocks broadly under pressure as the main driver of the market pullback. The Dow Jones Industrial Average dipped slightly by 1 point to 42,865. The S&P 500 fell 16 points or 0.3% to 6,022. The Nasdaq declined 99 points or 0.5% to 19,615. The Nasdaq Golden Dragon China Index, reflecting Chinese concept stocks, edged up 0.08%. Bilibili surged over 8%, driven by positive trends in its content ecosystem and user growth. Alibaba fell about 1%. Intel plummeted over 6%, marking its largest single-day drop in nearly 2 months, primarily due to unfavorable supply chain and market demand outlooks. Amazon and Apple dropped 2.2% and 2% respectively. Meta fell over 1%, while Nvidia, Alphabet, Tesla, and Microsoft saw modest declines. Oracle soared 13.3%, its biggest single-day gain since 2021, after reporting strong earnings post-market, with revenue exceeding expectations, particularly in AI-related cloud business, drawing investor attention. The market is optimistic about Oracle leveraging AI infrastructure for its next growth phase, especially in cloud services, competing with Microsoft Azure and AWS. Victoria's Secret plunged 29.7% after reporting a larger than expected first quarter loss, significant same-store sales declines, and a substantial downward revision of its full-year outlook. Concerns linger over slow brand repositioning, inventory pressures, and weakening consumer spending, casting a bleak short-term outlook. The U.S. May Consumer Price Index (CPI) rose 2.4% year-over-year, below the expected 2.5%. Core CPI increased 2.8% year-over-year, flat from the prior month and below the forecasted 2.9%. Month-over-month CPI rose 0.1%, down from 0.2% the previous month and below the expected 0.2%. Core CPI also rose 0.1% month-over-month, compared to 0.2% in April and below the anticipated 0.3%, reinforcing expectations of cooling inflation and a Federal Reserve rate cut starting in September. Trump reiterated calls for a 1% rate cut, but several Fed officials emphasized maintaining policy stability until trade policies and inflation trends become clearer. Investors will focus on next week's FOMC meeting and Powell's press conference. Meanwhile, the corporate earnings season is gradually kicking off. Our stock pick today is XtalPi Inc. Stock code 2228. XtalPi Inc. is the first specialized technology company listed on the Hong Kong Stock Exchange under Chapter 18C of the listing rules. By leveraging an AI plus robotics model, it has created a unique industry flywheel of high throughput experimentation, high quality data, and high intelligence models. This approach transforms traditional R&D methods, driving paradigm shifts in drug and materials development, empowering researchers, accelerating delivery, and overcoming bottlenecks in drug discovery and new material molecule development. Its robotic laboratory platform operates 24/7, rapidly accumulating high-quality data used to train various AI models. These models are applied in stages such as target identification, virtual screening, synthesis strategy recommendations, reaction outcome prediction, pattern searches, and structured data organization. For the year ending December 31st, 2024, the group achieved revenue of 266 million yuan, a 52.8% year-on-year increase, surpassing the Hong Kong Stock Exchange revenue threshold for commercialized companies, 250 million Hong Kong dollars, ahead of schedule. Adjusted net loss narrowed by 12.5% to 456 million yuan. In terms of operational efficiency, the group's AI plus efficient business strategy yielded significant results, reducing monthly cash burn by 22.6% to 48.1 million yuan. Looking ahead, the group will continue to iterate its proprietary AI plus robotics infrastructure, actively developing highly flexible and precise autonomous robotic laboratories. With ongoing accumulation of domain-specific data and models, the intelligence level of AI-driven decisions will steadily improve. Combined with the embodied development of experimental robotics, the DMTA design, make, test, analyze cycle for drug and material discovery can be autonomously completed through AI plus robotics. This continuous integration of AI and robotics will help build an intelligent R&D platform driven by a data flywheel, enabling the development of more drug and material molecules. The group is also committed to expanding its global presence, deepening its footprint in regions including the United States, Southeast Asia, Europe, and the Middle East. This year, the group signed a commercial cooperation agreement with the Sheikh Hamad Rakat Salam Rakat office of the UAE royal family, securing an initial $30 million deal to build the Middle East's first automated platform for modernizing traditional medicine R&D. This initiative pioneers a new paradigm for traditional medicine research in the region. Moving forward, the group will continue in-depth discussions with leading international companies on drug discovery solutions and automated robotic solutions. Recommendation: buy at 5.55 Hong Kong dollars, target $6.1, stop loss at $5.25. I do not hold the above stock.